Last Friday, I was invited for an interview at thestreet.com, and it was interesting. One of the first questions that the host asked me, first sort of just in a pre-interview, but then it obviously made it into the finished piece, was, would you suggest that people consider going to all cash at this particular venture? And my answer at the time was, yeah, why not? And that I think he was taken aback, especially because I sort of said it almost as a flippant answer, but it wasn't meant that way, and it wasn't reported that way. He understood. First of all, in hindsight, as of today, we're taping this nearly a week later. If you're an equity investor, that's a pretty good-looking call right now, considering what we've seen over the ensuing sessions. But that really wasn't. It wasn't really meant to be like an immediate market timing call, although it happened to work out that way. What I more wanted to elicit from it, and it was difficult to do it in their format, so I'm trying to do it here in ours, was that it's not clear to me that investors are getting compensated for risk, whether that investor is in stock markets or bond markets. I will say, if you were a bond investor and you'd listen to me, well, you gave up some capital appreciation. One of the features of this market has been a huge rally in the price of 10-year bonds and 2 and 5 year notes, which higher price leads to lower yield, which is why we see all this talk of lower yields and inverted yield curves and stuff. But the point there is, I do think the bond market is in danger of being overbought at the same time when the stock market isn't particularly a great value. And when I see trouble on the horizon, when you see the volatility coming, a lot of times it's a lot safer to be in cash. Various people, Warren Buffett most prominently among them, see cash almost equivalent to having some optionality. If you have cash, you get to deploy it when you see fit. It's not invested. You don't have to make a two-sided decision of what to reallocate it from and to, or what do I sell to buy something else. You have the cash and you deploy it when you see an opportunity. This is not necessarily saying, stick everything in your mattress here. But again, this is maybe to take a pause, especially as people are in vacation season. Cash is yielding. Cash, if you're at a firm that's paying a good yield, as hopefully you're invested with, your account is here at IBKR, and we do pay very good yields on idle cash. That's yielding higher than the 2 and 10 year notes are at this point. There are stocks that pay very good dividends, and certainly one should be looking at them, but you do run the risk in stocks of the asset depreciating faster than your yield returns, at least in the short term. So again, these are considerations. Again, doesn't mean you should be running and sticking all your money, hiding it somewhere in cash. It means that perhaps if you're a little bit unnerved by what you're seeing in the stock and bond markets right now, leaving some of your money in what's considered relatively high-yielding cash equivalents is not a bad way to go if you're feeling a bit risk averse right now.